Hello everyone, welcome to the 85th episode of me learning how to trade in Forex. So in the last video, we went through the hawkish versus dovish monetary policies. So the leader or a president or a chairman of a central bank, they can be either determined as either hawkish or dovish. Hawkish means tighten up. In support of raising interest rates to fight inflation, even to the detriment of economic growth and employment. And dovish means they have a more non-aggressive stance, so favour economic growth and employment over tightening interest rates. And then just basically a summary of what the hawkish and dovish factors are. And yeah, and now we're on fundamental factors that affect currency values. So, fundamental factors that affect currency values. Date is the 25th. So, there are several fundamental factors that help shape the long-term strength or weakness of the major currencies and will affect you as a forex trader. We've included what we think are the most important for your reading pleasure. Economic growth and outlook. Horror. Economic. We start easy with the economic outlook held by consumers, businesses and governments. It's easy to understand that when consumers perceive a strong economy, consumers feel happy and safe and they spend money. Companies willingly take this money and say, hey, we're making money, wonderful, now what do we do with all this money? Companies with money spend money, and all this creates some healthy tax revenue for the governments. They jump on board and also start spending money. Now everybody's spending, and this tends to have a positive effect on the economy. Weak economies, on the other hand, are usually accompanied by consumers who aren't spending, businesses who aren't making any money and who aren't spending, so the government is the only one still spending, but you get the idea. Both positive and negative economic outlooks can have a direct effect on the currency markets. The most commonly used measure of economic growth is GDP. GDP, not GFP, GDP is used to measure economic growth. GDP stands for Gross Domestic Product and represents the total monetary value of all final goods and services produced and sold within a country during a period of time. So, Gross Domestic Product represents the total monetary value of all final goods and services produced and sold within a country during a period of time, typically 1 year. Represents the total monetary value of all final goods and services produced and sold within a country during a period of time, typically 1 year. GDP provides an economic snapshot of a country used to estimate the size of an economy and growth rates. Here's a visualization from How Much Net that shows the 86 trillion global economy in one chart. $86 trillion global economy in one chart. So world's region, Africa, the purple, Australia, over here, other countries, over here, Latin America and Caribbean over here, Middle East over here, Europe over here, Asia over here, North America over here. As you can see, the United States is still the world's largest economy. China is the world's second largest economy. The United States and China together make up nearly 40% of the global economic GDP. The top 15 economies represent a whopping 75% of the total global GDP. Damn. Capital flows, globalization, technological advances, and the internet have all contributed to the ease of investing your money virtually anywhere in the world, regardless of where you call home. You're only a few clicks off a mouse away or a phone call for you folks living in the Jurassic era of the 2000s, from investing in the New York or London Stock Exchange, trading the Nikkei or Hang Seng Index, or from opening a Forex account to trade US dollars, euros, yen, and even exotic currencies. Capital flows measure the amount of money flown into and out of a country or economy because of capital investment, purchasing and selling. So, capital flows measure the amounts of money flowing into and out of a country or economy because of capital investment, purchasing and selling. The important thing you want to keep track of is capital flow balance, which can be positive or negative. When a country has a positive capital balance, capital flow balance is important. When a country has positive capital flow balance, foreign investments coming into the country are greater than investments heading out of the country. Foreign investments coming into the country are greater than investments heading out of the country. When a country has negative capital flow balance, investments leaving the country for some foreign destinations are greater than investments coming in. Foreign investments coming into the country are less than investments heading out of the country. With more investments coming into a country, demand increases for that country's currency, as foreign investors have to sell their currency in order to buy the local currency. With more investments coming into the country, demand increases for that country's currency, as foreign investors have to sell their currency in order to buy the local currency. Right. With more investments coming into the country, demand increases for that country's currency, as foreign investors have to sell their currency in order to buy the local currency. This demand causes the currency to rise in its value. This increase in demand causes the local currency to rise in value. Simple supply and demand, and you guessed it, If supply is high for a currency or demand is weak, the currency tends to lose value. Opposite is true. If demand is weak or supply is high for a currency, its value will drop. When foreign investments make an about face and domestic investors also want to switch teams and leave, and then you have an abundance of the local currency as everybody's selling and buying the currency of whatever foreign country or economy they're investing in. And domestic also, then you have an abundant. Foreign capital loves nothing more than a country with high interest rates and strong economic growth. If a country also has a growing domestic financial market, even better. Has a growing domestic financial market, a booming stock market, high interest rates, what's not to love? Foreign investments come streaming in, and again, as demand for the local currency increases, so does its value. So it's like a cycle, basically. Right. Trade flows and trade balance. International trade can be broadly distinguished between trade in goods, merchandise and services. The bulk of international trade concerns physical goods, while services account for a much lower share. So, international trades can be broadly distinguished between trade in goods, which is merchandises, and services. Bulk of international trade concerns physical goods, while services accounts for a lower share. World trade in goods has increased dramatically over the last decade, rising from about $10 trillion in 2005 to more than $18.89 trillion in 2019. We're living in a global marketplace. Countries sell their own goods to countries that want them, exporting, whilst at the same time buying goods they want from other countries, importing. Trade flows, largest global importers 2014, $1 trillion. So China exports, net import exporter, net export net exporter, net importer. So China is a net exporter because there's more exports going out than imports. US is a net importer or an importer because it has more stuff coming in than stuff going out. Percentage of GDP. Have a look at around your house. Most of the stuff, electronics, clothing, doggy toys lying around is probably made outside of the country you live in. If you live in the United States, look at all the different countries that the US trades with. Top 15 US trade partners, US imports, US exports, trade value in billions of USD of goods. Arrows do not denote specific routes, only source and destination. Every time you buy something, you have to give up some of your hard-earned cash. Whoever you buy your widget from has to do the same thing. US importers exchange money with Chinese exporters when they buy goods, and Chinese imports exchange money with European exporters when they buy goods. All this buying and selling is accompanied by the exchange of money, which in turn changes the flow of currency into and out of a country. Trade balance, or balance of trade or net exports, measures the ratio of exports to imports for a given country economy. So trade balance, or balance of trade or net exports, measure the ratio of exports to imports for a given economy. Measures the ratio of exports to imports for a given economy. It demonstrates the demand for that country's goods and services, and ultimately its currency as well. If exports are higher than imports, a trade surplus exists and the trade balance is positive. If imports are higher than exports, the trade deficit exists and the trade balance is negative. Trade deficits have the prospect of pushing a currency price down compared to other currencies. Wait, let me just write this down. If exports are higher than imports, a trade surplus exists and the trade balance is positive. If exports are lower than imports, if imports are higher than exports, a trade deficit exists and the trade balance is negative. So exports is bigger than imports equals trade surplus equals positive trade balance. Imports bigger than exports equals trade deficit, which equals negative trade balance. Trade deficits have the prospect of pushing a currency's price down compared to other currencies. So trade deficits have the prospect of pushing a currency price down compared to other currencies. So trade deficits pushing a currency price down compared to other countries. Why does it do that? So if your imports are higher than your exports, so if you're buying more stuff compared to selling more stuff, your currency price gets pushed down because you are exchanging your money to another country's money, which increases their demand of the currency, of the local currency. So if you increase their demand, that means the price of their currency is going to rise. Whereas yours, you don't really have that much demand for your currency, but your supply is decreasing, right? If your supply is decreasing, then surely that would increase the currency value as well, but it doesn't work like that, I don't think. So trade deficits have the prospect of pushing a currency's price down compared to other currencies. Net importers first have to sell their inventory currency in order to buy the currency of the foreign merchant who's selling the goods they want. Yep. When there's a trade deficit, the local currency is being sold to buy foreign goods. Yep. Because of that, the currency of a country with a trade deficit is less in demand compared to the currency of a country with a trade surplus. Which countries are net exporters and importers? Selected countries by positive, negative current account balance in billion US dollars. What's it called? Trade balance, balance of trade and net exports. So net imports, exporters, net importers. Current, so these are the positive ones, negative ones, so these currency for these countries are going to be less in demand, so their value would be lower. Net exporters, countries that export more than they import, see their currency being bought more by countries interested in buying the exported goods. Trade surpluses tend to experience currency appreciation. So trade surplus tend to experience currency appreciation, so a currency price going up. It is in more demand, helping their currency to gain value. It is all due to demand for the currency. That's because when exporters convert the foreign currencies they earn abroad into their domestic currency, this tends to put upward pressure on the domestic currency. Wait, let me read that again. That's because when exporters convert the foreign currencies they earn abroad into their domestic currency, this tends to put upward pressure onto the domestic currency. What does upward pressure mean? Currencies in higher demand tend to be valued higher than those in less demand. It's similar to pop stars. Because she's more in demand, Taylor Swift gets paid more than Pink. Same thing with Justin Bieber versus Vanilla Ice. Currencies in higher demand tend to be paid more, tend to be valued higher, not paid more, than those in less demand. The government, present and future. After the great financial crisis caused by the Great Recession during the late 2000s, all eyes were glaringly watching their respective countries' governments, wondering about the financial difficulties being faced and hoping for some sort of fiscal responsibility that would end the woes felt in our wallets. A decade later, we now face a similar situation as the world tries to navigate a global health crisis and economic collapse caused by the coronavirus COVID-19 pandemic. Instability in the current government or changes to the current administration can have a direct bearing on that country's economy and even neighbouring nations, and any impact on the economy will most likely affect exchange rates. Right. There's a lot of stuff being written in here. Okay. I think I got most of the important stuff down. So, yeah, on to the next one. Where to find Forex news and market data. A quick Yahoo Googling, that's Yahoo, Google plus Bing, search of Forex plus news or Forex plus data returns a measly 30 million results combined. 30 million, that's right, no wonder you're here to get some education. There's just way too much information to try to process and way too many things to confuse any newbie Forex trader. That's some insane information overload if we've ever seen it. But information is king when it comes to making successful trades. Currency price moves because of all this information, economic reports, a new central bank chairperson, and interest rate changes. News moves fundamentals and fundamentals move currency pairs. It's your goal to make successful trades, and that becomes a lot easier when you know why the price is moving the way it is. Successful forex traders aren't born successful, they were taught or they learned. Successful forex traders don't have mystical powers, well, except for Pipcrawler, but he's weirder than he is mystical, and they can't see the future. What they can do is see through the blur that is forex news and data, pick what's important to traders at the moment, and make the right trading decisions. Where to find forex news and market data? Market news and data are available through a multitude of sources. The internet is the obvious winner in our book, as it provides a wealth of options and at the speed of light, direct to your screen, with access from almost anywhere in the world. But don't forget about the print media and the good old tube sitting in your living room or kitchen. It's like the TV tube. Individual forex traders will be amazed at the sheer number of currency-specific websites, services, and TV programming available to them. Most of them are free of charge, while you may have to pay for some of the others. Let's go over our favorites to help you get started. Traditional financial news sources. Whilst there are tons of financial news resources out there, we advise you to stick with the big names. These guys provide around-the-clock coverage of the markets with daily updates on the big news that you need to be aware of, such as central bank announcements, economic report releases, and analysis, etc. Many of these big players also have institutional contacts that provide explanations about the current events of the day to the viewing publics. Reuters, The Wall Street Journal, Bloomberg, MarketWatch.com, CNBC. So, places to find forex news and data. Reuters, The Wall Street Journal, Bloomberg, MarketWatch.com, CNBC. Real-time news feeds. If you're looking for more immediate access to the movements in the currency market, don't forget about the 80-inch flat-screen TV in your bathroom. Financial TV networks exist 24 hours a day, 7 days a week to provide you up-to-minute action on all of the world's financial markets. In the US, the top dogs are, in random order, Bloomberg TV, Fox Business, CNBC, MSNBC, and even CNN. You can even throw a little BBC in there. Another option for real-time data comes with your forex trading platform. Many forex brokers include live news feeds directly in their software to give you easy and immediate access to events and news of the currency markets. Check your broker for the availability of such features. Not all brokers' features are created equally. Economic calendars. Wouldn't it be great if you could look at the current month and know exactly when the Fed is making an interest rate announcement, what rate is forecasted and what rate actually occurs, and what type of impact this change has on the currency markets? It's all possible with an economic calendar. The good ones let you look at different months and years, lets you sort by currency, and lets you assign your local time zone. 3 p.m. where you're sitting isn't necessarily 3 p.m. where we're sitting, so make use of the time zone feature so that you're ready for the next calendar event. Yes, economic events and data reports take place more frequently than most people can keep up with. This data has the potential to move markets in the short term and accelerate the movement of currency pairs you might be watching. Lucky for you, most economic news that's important to forex traders is scheduled several months in advance. So which calendar do we recommend? We look no further than our very own babyhits.com Forex economic calendar to provide all that goodness. If you don't like ours, which we highly doubt, a simple Yahoo Googling search will offer up a nice collection for you to examine. So, real-time news feeds, economic calendars, market information tips. Keep in mind the timelines of the market of the reports you read. A lot of this stuff has already occurred and the market has already adjusted prices to take the report into account. If the market has already made its move, you might have to adjust your thinking and current strategy. keep tabs on just how old this news is, or you'll find yourself yesterday's news. You also have to be able to determine whether the Forex news you're dealing with is in fact is fact or fiction, rumor or opinion. Right, so keep in mind the timeliness of the reports being read. See if the market has already adjusted its prices to take the report into account. You also have to determine whether the Forex news is fact or fiction, rumor, is fact, fiction, rumor, or opinion. Economic data rumours do exist, and they can occur minutes to several hours before a scheduled release of data. The rumours help to produce some short-term trader action, and they can sometimes also have a lasting effect on market sentiment. Institutional traders are also often rumoured to be behind large moves, but it's hard to know the truth with a decentralised market like a spot forex. There's never a simple way of verifying the truth. Institutional traders are also often rumoured to be behind large moves. Your job as a forex trader is to create a good trading plan and quickly react to such news about rumours after they've been proved true or false. Having a well-rounded risk management plan in this case can save you some moolah. And the final tip, know who's reporting the news. Are we talking analysts or economists, or the owner of the newest Forex blog on the block, maybe a central bank analyst. The more reading and watching you do of Forex news and media, the more finance and currency professionals you'll be exposed to. Are they offering merely an opinion or a stated fact based on recent released data? The more you know about the who, the better off you will be understanding how accurate the news is. Know who is reporting the news. The more you know about the who, the more understanding in determining how accurate the news is. Those who report the news often have their own agenda, have their own strengths and weaknesses. Get to know the people that know, so you know. Can you dig it? Get to know the people that know what they're talking about, so you know that what they're talking about is real and not some made up stuff. I think that's what it means. Okay. Market expectations of news and their impact on currencies. Market expectations of news and their impact on currencies. There's no one all-in or bet the farm formula for success when it comes to predicting how the market will react to data reports or market events, or even why it reacts the way it does. You can draw on the fact that there's usually an initial response which is usually short-lived but full of action. Later on comes the second reaction, where Forex traders have had some time to reflect on the implications of the news or report on the current market. It is at this point where the market decides if the news releases went along with or against the existing expectation, and if it reacted accordingly. Was the outcome of the report expected or not, and what does the initial response of the market tell us about the bigger picture? Answering those questions gives us a place to start interpreting the ensuing price action. So usually initial response, which is usually short-lived but full of action. Then comes the second reaction, where traders had some time to process, reflect on the implications of the news on the current market. The market then decides if the news release went along with or against the existing expectation, and if it reacted accordingly. Was the outcome of the report expected or not, and what does the initial response to the market tell us about the bigger picture? Answering those questions gives us a place to start interpreting the ensuing price action. Consensus market expectations. A consensus expectation, or just consensus, is a relative agreement on upcoming economic or news forecast. Consensus expectation is the relative agreement on upcoming news or economic forecast. Economic forecasts are made by various leading economists from banks, financial institutions, and other securities-related entities. Your favorite news personally gets into the mix by surveying her in-house economists and a collection of financially sound players in the market. All the forecasts gets pulled together and averaged out, and it's these averages that appear on the charts and calendars designating the level of expectation for that report or event. The consensus becomes ground zero. The incoming or actual data is compared against a baseline number. Incoming data normally gets identified in the following manner. As expected, the reported data was close to or at consensus forecast. Better than expected, the reported data was better than the consensus forecast. Worse than expected, the reported data was worse than the consensus forecast. Whether or not incoming data meets consensus is an important evaluation for determining price action. Just as important is the determination of how much better or worse the actual data is than the consensus market. Large degrees of inaccuracy increases the chances and extent to which price may change once the report is out. However, let's remember that Forex traders are smart and can be ahead of the curve, well, the good ones anyway. Incoming data is compared against this consensus. And are identified in the following manner. So, as expected, reported data was close to or at the consensus forecast, better than expected, reported data was better than the consensus forecast, worse than expected. Reported data was worse than the consensus data forecast. Whether or not the incoming data meets consensus is an important valuation for determining price action. How much better or worse the actual data is than the consensus forecast. So important to determine how much better or worse the actual data is than the consensus forecast. Larger degrees of inaccuracy increases the chance and extent to which the price may change once the report is out. What's priced in? Many Forex traders have already priced in consensus expectations into their trading and into the market well before the report is scheduled, let alone released. So most traders have already priced in consensus expectations into their trading and into the market well before the report is scheduled. As the name implies, priced in refers to the traders having a view on the outcome of an event and placing bets on it before the news comes out. The more likely a report is to shift the price, the sooner traders would price in consensus expectations. How can you tell if this is the case of the current market? Well, that's a tough one. You can't always tell, so you have to take it upon yourself to stay on top of what the market commentary is saying and what price action is doing before reports gets released. The more likely a report is to shift the price, the sooner traders will price in consensus expectations. This will give you an idea of how much the market is priced in. A lot can happen before a report is released, so keep your eyes and ears peeled. Market sentiment can improve or get worse just before a release, so be aware that price can react with or against the trend. Can improve or get worse just before a release. So price can react with or against the trend. There is always a possibility that a data report totally misses the expectations, so don't bet the farm away on the expectations of others. When the miss occurs, you'll be sure to see price movement occur. Help yourself out for such an event by anticipating it and other possible outcomes to happen. Play the what if game. Ask yourself, what if A happens? What if B happens? How will traders react or change their bets? You can even be more specific. What if the report comes in under expectation by 0.5%? How many pips down would the price move? What would need to happen with this report that could cause a 40 pip drop? Anything. Come up with your different scenarios and be prepared to react to the market's reaction. Being proactive in this manner will help you ahead of the game. Come up with different scenarios and be prepared to react to the market's reaction. Expectation reality. What the heck, they revised data, now what? Too many questions in that title. But that's right, economic data can and will get revised. Economic data can and will get revised. That's just how economic reports roll. Let's take the monthly non-farm payroll as an example. As stated, this report comes out monthly and usually includes with it are revisions of the previous month's numbers. We'll assume that the US economy is in a slump and January's NFP figure decreases by 50,000, which is the number of jobs lost. It's now February and NFP is expected to decrease by another 35,000. But the incoming NFP actually decreased by only 12,000, which is totally unexpected. Also, January's revised data, which appears in the February report, was revised upwards to show only a 20,000 decrease. As a trader, you have to be aware of situations like this when the data is revised. Be aware of when data gets revised. Not having known that January data was revised, you might have a negative reaction to an additional 12,000 jobs lost in February. There's still 2 months of decreases in employment, which ain't good. That's still 2 months of decreases in employment, which ain't good. However, taking into account the upward revised NFP figure for January and the better than expected February NFP reading, the market might see the start of a turning point. The state of employment now looks totally different when you look at the incoming data and last month's revised data. Be sure not only to determine if revised data exists, but also the scale of revision. Check not only to determine if the revised data exists, but also the scale of revision. Bigger revisions carry more weight when analysing the current data releases. Bigger revisions carry more weight when analysing the current data releases. Revisions can help confirm a possible trend change or no change at all, so be aware of what's been released. Can help to confirm a possible trend change or no change at all. Quiz time, fundamental analysis. Economic developments, government policies and geopolitics drive market sentiment. Do you have the basic understanding of what moves the markets? What is fundamental analysis? The study and use of economic, political and environmental reports to forecast future price action. Which of the following is not related a fundamental event. An important price level is broken. Is the market's anticipation for an economic indicator more important than the actual economic results? Is the market's anticipation for an economic indicator more important than the actual economic results? They're both equally important. What does RBNZ mean? Royal buttocks of Nigel Zuckerberg. Reserve Bank of New Zealand. What is the difference between the interest rates of two currencies called interest rate differential? An increase in interest rates usually leads to slower economic growth. This type of monetary policy aims to decrease the money supply to slow down the economy. Restrictive. Monetary policies that aims to increase the money supply to help grow the economy. Expansionary. What is typically the main goal of a monetary policy? To get Ferraris for everyone. Maintain price stability and economic growth. Central bankers are hawkish when they favour the needs for higher interest rates. Central bankers are dovish when they favour the need for low interest rates. Why is the economic outlook important in fundamental analysis? Consumers spend more on iPhones when they anticipate strong economic growth. Forex analysis can gauge the potential currency direction better by estimating future economic conditions. Can't you see the outlook just means look out? Yeah, okay, it's this one. A trade deficit happens when imports exceeds exports. Which of the following is not a good source of market information? Your blind barber. What is a consensus? A relative agreement to an upcoming economic forecast. What is a good way to prepare for a release of an economic report? Think of different scenarios based on recent leading indicators and be prepared to react to different possible market reactions. Utter perfection. Let's go. Cool. Okay. The fundamental analysis is all done. There's a lot of stuff that I need to get my head around, but yeah, it's going to require a lot of reading, I think. That's what it is, and understanding and just interpreting what the information actually means instead of just looking at a base layer level. You got to try to link some of the information together and, you know, see how they not correlate, but how they react to each other and how the currencies might react to whatever the news says, you know. So yeah, I'm going to leave this episode here then. In the next video we're going to start doing currency crosses section. So yeah, thank you all for watching and I will see you then. Peace.